best freaking night of my life, and wherever it takes me, I'm down for the ride. Baby, don't you know I'm good? Yeah, I'm feeling alright. 'Cause I'm good, yeah, I'm feeling alright. Baby, I'ma have the best freaking night of my life, and wherever it takes me, I'm down for the ride. Baby, don't you know I'm good? Yeah, I'm feeling alright. Don't you know I'm good? Yeah, I'm feeling alright. You know I'm down for whatever tonight. I don't need the finer things in life. No matter where I go, it's a good time. Yeah. And I don't need to sit in VIP. Middle of the floor, that's where I'll be. Don't got a lot, but that's enough for me. Yeah. 'Cause I'm good, yeah, I'm feeling alright. Baby, I'ma have the best freaking night of my life, and wherever it takes me, I'm down for the ride. Baby, don't you know I'm good? Yeah, I'm feeling alright. Don't you know I'm good? Yeah, I'm feeling alright. So I just let it go, let it go. Oh na 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 na, no I don't care no more, care no more. Oh na 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 na, so come on, let me know, let me know. Put your hands up, na na na, no baby, nothing's gonna stop us tonight. 'Cause I'm good, yeah, I'm feeling alright. Baby, I'ma have the best freaking night of my life, and wherever it takes me, I'm down for the ride. Baby, don't you know I'm good? Yeah, I'm feeling alright.
Hello,
Hello, how are you?
how are you? Fine. How are you?
I'm doing great. I'm doing great. Oh man, what time is it over there?
Mm, It's so early. It's 6 a.m.
Oh, 6 a.m. Oh, wow. Okay, good stuff. Well,
Thank
we'll go ahead and
you
get
for
started with
nice.
the presentation, and then we are recording this for that way for other people who have missed this webinar. They can watch it in the future as well. And if you have any questions, and you can go ahead and type in the chat, and we'll get to it as soon as we can, okay? Okay, so can you see my screen?
Yes, good.
Okay,
Thank
okay,
you
great.
for invitation. Okay, sure.
Oh, okay, great.
Thank you.
You're welcome. Okay, so we'll go get started here. So just wanted to do a little bit introduction of who we are. My name is Jan. I'm the founder of Fortune Homes team, and we started real estate investing back in 2011, so roughly 13, 14 years ago. And around 2014, after we were successful at doing several deals in real estate investing, I was able to leave my full-time job and start my business full-time and start expanding from there. We started creating a national network of real estate professionals 10 years ago, since 2014. And since then, Fortune Homes team has now owned and operates different companies as well. One of them being an educational company called RE Street Smart, which is Real Estate Street Smart. It's an educational division that has trained over 1,000 students since 2015. And we also own and operate a construction company that does primary residential construction, servicing the DC, Maryland, and Virginia area since 2020. And then we also own and operate a capital investment company servicing nationwide deals since 2017. So we'll go through this particular business tonight. That's the purpose of this webinar, is with regards to capital investing, okay? All right. So, basically the whole idea of Fortune Homes Capital is to help folks with capital, with cash capital, to grow their capital in the comforts and safe havens of real estate. Okay. So why do we choose real estate? And I personally have could have done any other business. I could have done so many other different businesses with my background in engineering and IT and so forth, and created new products. But I ultimately chose real estate because it's the most safest investment there is out there, because there always will be a demand for it through population, because our population increases in the United States every year through immigration and through birth. So, when there's technical stuff or maybe textiles or things like that, they always come and go, right? Some people might like this cabinet this year, they might like a different cabinet next year. They might like this iPhone this year, they might like Android next year, right? So there's always going back and forth with different products. But real estate, everyone needs a place to live, right? So that's why I chose it. There's never any competition other than those who do the same industry. So since the beginning of time, human beings have always needed shelter. All right. So, and our standard of living's always continued to improve every single generation. All right. So we started off living in caves and huts, and then log cabins, and then houses, and then ramblers, and then now colonials, that has at least 2 bathrooms, because today's families, if they didn't have 2 bathrooms, they didn't want to buy the house, right? So where I grew up, I only have 1 bathroom for a family of 7. Me and 5, we have 5 siblings, and my 2 parents were 7 in the family, and we only had 1 bathroom, and we were able to live that way. But today, that's no longer acceptable, because the standard of living here in the United States have continually to increase and improve every single generation. Okay. And then also a multifamily, where you have multiple people or multiple families living in the same building through multi-units and multi-units inside the building. And then, of course, controlled income growth. And I like the word control because, there's a lot of different ways to invest capital. And here in the United States, they have, people get sold on buying mutual funds, they get sold on buying stocks or different funds that grow within that group and that firm. But really, when you give that money to them, who's really in control? It's not you. It's really based on the performance of that fund and which company they're investing in. So let's talk about stocks real quick. Most people here in the United States, they are very familiar with stocks because, when we go to high school and then go to college, we learn economics and we learn about the stock market. So the stock market is a part of the curriculum in the education program, but rarely they even talk about real estate. Okay. So stock investors, where do average people learn this? They learn it through school, they learn it through advertisements, they learn it when they open a bank account at any major bank, such as Wells Fargo, Bank of America. While they're opening their own checking account, that person opening the account is start going to talk to them about different investment vehicles for them to put their money to. Okay, so they get sold on these different investments in the stock market. But then what can an average person control in the stock market? And the answer is, well, not much. And I mean, I'll give an example here. This is a pretty old image here of the stock for Amazon. So Jeff Bezos is the one who's the CEO right now. And if you're not the CEO, or if you're not on the board of directors, or if you're not an officer of the company, then you have very little control on how which direction that company goes to be able to improve the performance and cash flow of the value of the company, right? So the difference is in real estate. So in real estate investors, what we can do is we can control acquisition costs. So if the deal is too expensive, we don't have to buy it, right? We can continue negotiating to get a better deal. So that way the margins are acceptable. And also we can control the value add plan, meaning what can we do to the property to make it more valuable, make it worth more, right? So is it additional amenities? Is it adding a bathroom? Is it renovating a specific thing? What can we do to add value to that so that way it increases the value? And exit strategy simply means that every deal that we do in real estate, before we even begin, we have to think about the end. What is the exit? So before we enter, we already know what the exit is. Okay, so we can control the exit strategy. So when banks out there, they're in business to loan out money. So if you think about it, what investments will banks be willing to loan money to purchase? Will they allow you to loan? Will they loan you money to buy stocks or mutual funds? All right, and the answer is no. Even though the mutual fund is under their company. Okay, so it's amazing they won't loan money for you to buy stocks or mutual funds, but they will loan money for real estate. And that's called a clue, because the banks know the risk tolerance of real estate versus a particular stock long term. Okay. So real estate, that's why I chose real estate, because if the banks find it as a good investment, then so should I, right? Okay, so basically what we're doing here is we're looking for qualified capital investors, basically those who are very unhappy with the small interest they're currently earning in their savings account, money market account, or certificate of deposit account. So even though the interest rates here in the United States have gone up in the last several years, it's still not a lot. You know, some people who have a money market account, they're earning about 2, maybe 3% at most, okay? But the rate of inflation still today is around 7%. So even though you're putting your money in the money market account at 3%, you're still losing value because inflation is at 7% still. So you have a difference of negative 4% because of inflation. So our goal is to help you make your money higher than inflation, so that way you can grow your wealth and not shrink your wealth. Okay, those who are tired of seeing fluctuations in the stock market or mutual funds. And then you have access to capital, but really don't know how or where to invest and what different vehicles are available for you and what kind of benefit you can get from a long-term investment. And also, you know, someone who wants to earn a fixed return with opportunities of profit sharing in a secured investment vehicles managed by experts. Okay, so why are we doing this? Okay, so for us, we've been doing this for 10 years, and we can continue doing the same way we've been doing it with our own capital. But what we want to do is tackle bigger, safer deals and allow us to increase our volumes, because there's a lot of opportunity out there that a lot of times we pass we pass over because of the available funding that we have. So we have a pool of investors that have access to capital that we can take advantage of some of these good deals that come across our desk. Okay. Also supports our growing student base. So we trained a lot of students already for the past 10 years or so. And so these students are also doing the same thing we're doing. And so they're going to need capital as well. So it's not just us doing deals, but also those we have trained as well. So the volume of deals is pretty high. Also to support a growing network of experienced investors, okay? And then also gives us opportunity for higher returns to investors who are unhappy with the current returns, okay? All right, so how does it work? So someone like you is a capital investor, all right, you have, let's say, a set dollar amount, all right, and then you want to invest that money into our firm, Fortune Homes Capital. So what we do is, before we even have any kind of agreement with you or any kind of transfer of funds, we are going to underwrite a deal. We're going to review the actual deal itself and also the value add plan, and we're going to approve or deny it, okay? And so basically, we have a very strict criteria to make sure that our margins are safe for our investors, so that way their money is safe, and at the same time, they have a high chance of good profit sharing at the end of the day. Okay, and then once we underwrite the deal, we find that it's qualified. Then this deal could be a single family renovation. So they buy the house, they fix it, they sell it for profit. So that's one opportunity. Another one could be a land development or a condo conversion. And basically, what this is that you have a piece of land. Let's say it's 20 acres, and there's opportunity for us to subdivide that and build a road and build some amenities there. So that way, a builder can come in and build multiple houses on that piece of property. So that's land development. And then multifamily apartment, okay? And by far, I think multifamily apartment buildings is the safest one, because when we acquire a multifamily building, people are already living there paying rent. So there's already instant cash flow. And the whole goal of the multifamily is for us to improve that cash flow over a period of several years, so that way the property value increases, and that's how we pay back our investors with profit sharing. Okay, and once the deal is done, then the returns on investment goes back to the investor. All right, and then the investor can choose what they want to do with that. They can choose to reinvest the money to grow even further, or they can choose it for their own personal expenses or other deals that they may have in their pipeline. Okay, so the choice is up to the investor of what they want to do with the returns and the principal that they get back. Okay, so there's 3 different products out there. The first one, I also call it the rehab to sell or rehab to rent. Okay, typically this type of investment, it's a hold period of 6 to 12 months. It's a time frame from purchase to sale or refinance. Okay, and so once the sale or refinance is done, the investor gets the principal back plus the return. Okay, so that whole goal is basically buy the house, fix it, and then sell it or rent it, and then refinance it to get all the money out of it to pay back all the investors with their return on investments, okay? The second one is land development. And this generally takes 12 to 24 months, okay? So the whole goal here is to manage a piece of property and then go through the county to get zoning approval for it to be subdivided, so multiple homes or a mixed excuse me, multiple homes or mixed-use buildings can be built on that particular land, and then or be sold to a builder to build their own facilities for a profit. Okay, and then the last one is buy and hold with value add, and these are generally multifamily buildings of 20, 30, 40. 50, 100, 200 units. And all we're doing is we're buying the apartment building with tenants inside. Okay, and the reason why we're getting a good deal is because either the existing owner is motivated enough to sell at a discount, or they've inherited the property, or they've done some things that mismanage a property to where there's opportunity for us to grow its value. So we have to buy at a discount and be able to for us to exercise that value add plan. Okay, so the whole goal is to improve the business of the multifamily building, to improve the cash flow and net operating income through increased occupancy or other amenities that you can charge to the tenants there. And this generally takes about 3 to 5 years, okay, 36 months to 60 months. Okay. All right. So the returns on investments, these are different, basically I'm sorry. This is an illustration. Let me go back to the slide. This is just an illustration of what you can expect. This is not, every deal is different. Okay. But this is just to show what it looks like. So for any particular amount of investment, so let's say someone wants to invest $100,000, they're going to get a guaranteed fixed return on their investment. Okay. And then that fixed return increases when the amount of money invested in subscription is higher. So an example of 100,000, they'll get 5.5%. But in the example of 500,000, they'll get 8% or 7%, depending on the deal. But basically, the higher the dollar amount, the more guaranteed return that you'll have on that investment. And then the profit share gets added to the end based on the performance of the deal. Then that will update you on accordance to our business plan. Okay, so going through a couple of things, how can you invest? Bill Gates, multi-billionaire, once said you should never undervalue your assets. You can always take a look at your cash resources through your liquidity in your bank, home equity loans, lines of credits, or equity inside your business, your 401k, retirement plans, and life insurance. So there's a lot of different ways to navigate access to cash for you to invest in a controlled environment in real estate. Okay, so we've had a lot of people who've worked for many years, and they have a 401k, and they convert that 401k into what's called a self-directed IRA, so they can direct the retirement money, tax deferred, into an investment. And when they get the returns on investment, the profits back, it goes back into the self-directed IRA, and they don't pay any taxes on it because it goes back into their IRA account. Okay, and then now they have a bigger account. So let's say they started with $100,000, and now it grew to $125,000. Then they can take the $125,000 before paying any taxes and reinvest that again to have a snowball effect to grow that bucket of money. Okay, so the following year, instead of being $125,000, it may be $175,000, and then they can reinvest at 175 to now make 250,000 and so forth. Okay, so they can snowball that effect with the bigger without having to pay taxes through their self-directed IRA. Okay. All right, and then going on to the next one. So here's an example. Okay, I want to share through an example, and then we have an existing opportunity I want to share with you guys. So this is a particular house in DC, and you see here on the left picture is a before picture. On the right side, it's a after picture. Okay, so you see the one on the left looks really old and very outdated with trees blocking the beautiful house, and then on the other side, you took down those trees and then we painted the brick to make it look brand new again, and then we sold it. So the capital investor here in this one invested $245,000 into this deal. Okay, he earned a 6.5% fixed APR over 7 months. That's $9,300. Okay, and then in addition to that, they also earned a profit sharing based on the performance of the deal. He got an additional $16,000 out of the whole thing. So the total return on investment over 7 months was $25,300, or an effective return of 17.7% on that particular deal. So that's annualized. Okay, so they're very happy with that. Now the downside about this one is that they're only able to deploy their money for 7 months. So obviously 7 months, earning 17.7% is great. But now when he got his money back, it's not performing again. So it's just sitting there in his bank account, not performing again until he finds the next deal. So the good thing about the rehabbing approach is that you get your money back faster. But the bad thing is that now you have to go shop for another deal. Okay. And then all the while you're shopping, your money in the bank is not performing. So that's a downside to that. Okay. All right, so here's another. So here's what happened. Okay, here's what happened. Actually, he took $80,000 from his HELOC. Okay, he paid part of his. I'm sorry, part of his $245,000 was $80,000 from his home equity line of credit. So on the $80,000, he paid 4% on his home equity loan. All right, then he started earning 5% on the deal for that particular investment, earning $2,000. Okay, and this illustration is profit sharing, and it's $7,500, and then total return before anything was $9,500. So even though the cost of his HELOC was 4% over 6 months, $1,600, he ended up making $9,500 through the whole thing. So return of $7,900 using personal cash, or an effective rate of 19.8%. Okay, so you can do a number of things. You can use your own capital. You can borrow money against your own equity, against your own business, or maybe you have stock options you can borrow against, or things like that. There's a lot of different things you can do to get access to the capital, so that way you can pay yourself or invest in yourself here in real estate. Okay, the next thing is that with regards to competition and risk mitigation, is that one of the things that we really pride ourselves on is that Fortune Homes has a large network of vendors and agents that can help us mitigate the risk to the deal. So as an example, all right, at the bottom here, you'll see here that if you went on with any other firm or any other any other investment firm, they're going to go ahead and have a real estate acquisition financing and value add financing with other lenders. Okay, but what happens is that they loan the money, they invest the money into that deal, but then they count on that developer to perform properly. Okay, so you'll see here that the quality process, training, mentorship, vendor management, exit strategies, and real estate agents, it's all done by an independent vendor where that firm has very little control over. So they're going to underwrite it, right? They're going to look at the risk behind everything, and then they're going to loan when it fits the underwriting criteria. But yet there's still a bit of risk because there's no control of the actual investment while it's being executed. Okay. Whereas for us, Fortune Homes Capital, we cover through the whole spectrum of everything, because in Fortune Homes Capital, not only are we involved in the acquisition financing, the value add, but in the quality process and training and mentorship and vendor management as well. As an example, okay, so if one of our students were to do a deal, part of our training and mentorships helps mitigate the risk by them doing the right thing based on their investment. Okay, so whether it be a fix and flip or a multifamily or some kind of land development, they're working under our umbrella and our expertise and our team of expertise to be able to mitigate that risk. In addition to that, we have used in the past 10 years vendors that have never failed us. All right, whether it be lawyers or accountants or construction crew or contractors or home inspectors or licensed agents. We have all that in our network already that we know they perform and perform well. And so when these folks do some of these deals, all right, they are using our approved vendors as well that we have used in the past, that allows them to mitigate the risk even further. So that way they can make a higher profit without them having to shop to other people with all these different vendors. Because when you do a deal, you need to work with different vendors to get that deal to move forward. Okay. As an example of a site developer. Okay. So let's say someone bought a 20-acre lot, and they don't know a good site developer, okay, someone who can do the drawings and get the zoning approvals from the county. We have all that in our network already, so they can use someone who's already had past performance and does well with that. Okay, same thing with multifamily property managers, sponsors, and those who are experienced in doing those kinds of deals. They're already in our network, so the risk of doing the deal becomes a lot less because we provide those as part of the deal. Okay, now does that happen all the time? And the answer is no. It all depends on where our team is available. So if they're doing a particular deal that's outside our local marketplace, let's say Texas or Florida, then we may not have a team that we've done there before, but we do even more thorough vetting of that deal if that's the case. Okay. All right. And then, so how do we do it? So we mark and identify opportunities, right? Whether it be us or the folks that we work with. We inspect the property or look at the value add plan, complete the analysis to ensure the appropriate margins of risk, and then the person who is doing the actual deal will send a contract for offer to the seller's party. So if it's a single family rehab, it's a regular, really simple contract. If it's a multifamily building, it starts off with a letter of intent and then goes on to a ratified contract later after the feasibility period has expired. And then you undergo through negotiations and then get the offer accepted. And then once the offer is accepted from both parties, then we prepare for closing and underwriting that particular investment based on the final numbers that were agreed upon. Okay. And even though that the offer has been ratified already, in the underwriting process, there have been times where we find some things that didn't work out very well from a numbers perspective, and we gave the developer an opportunity to renegotiate the deal to get a better deal, so that way they will put themselves in a less risky position. And that's happened before in the past, to where they're already got the offer accepted, but when we try to underwrite the loan, it's like, hey, you may need to do a couple of changes to your negotiations because you're putting yourself in a very slim margin and a high risk position. Okay, even though they're going to bring a lot of money to the table as a down payment, they're putting themselves at risk, and we don't want them to lose money. So we want to advise them to say, hey, I think you may need to do a couple of things here to be able to make your deal even more profitable and less risky based on the changes in the markets that we see coming along in the next 6 to 9 months. Okay, and then once it's all done, then the developer or the borrower will go ahead and perform the value add plan, and then pays the loans as agreed. Okay, and then they execute the exit strategy, and then repays the principal as agreed, as signed. Okay, and then of course we repeat the process all over again. Okay, so experienced team, we have we have a lot of people in our team, as I mentioned earlier, and our vendors. So these are just a handful of the ones that we work with commonly. Very often. So the law office of Christopher Markham has done a lot of work for us from a legal perspective. District Title has done a lot of things for us from a legal and title perspective. PMI Property Management of Fairfax, they've done a lot of our property management work for rental properties, and then Fortune Homes Construction, the company that we own personally, that does construction work for residential property. Okay. All right, and so let's go on to the opportunity that we have today. And this is a multifamily building here at 4951 G Street Southeast in Washington, D.C. So this is a picture of the outside and going to the parking lot. This is considered a Class C type deal. Okay, so Class C meaning that it's not a luxury resort or anything like that, but it's more of an average type blue collar neighborhood. Okay. In fact, most of these tenants here are all subsidized by the government with Section 8 housing, with Section 8 rents. Okay. So here's a couple of things about the investment description. Okay. The great thing about this deal is that it has an assumable loan of $6.5 million at a current interest rate of 3.16%. So 3.16% is a killer loan at $6.5 million. All right. And through a 30-year amortization that we will be assuming in this particular deal. Okay. So that's a great deal in itself. And it's also not interest only, but it's also interest and principal payments. So as the tenants pay the rent and we pay the mortgage on a monthly basis, the principal balance goes down, thereby increasing the equity of the property as well. Okay, so there's 45 total units as an existing as it is. Okay, and so I'm gonna go through some of the numbers. Okay, so here's some more pictures here. Okay, all right, some more pictures of the inside of the house. Okay, all right. So at a glance, all right, for those who are investing on this one, since it's a multifamily building, we're looking at a 3 to 5 year commitment, and the annual returns, including preferred rates and also the LP, the limited partnerships, equity growth is about 15% or higher, depending on the investment amount. Okay, so over 5 years, you're looking at increasing your equity of whatever position you have by 80%. It's what I call a 1.8x multiplier over 5 years. So when you invest in multifamily, I always look for the multiplier, what kind of opportunity there is throughout the entire deal. Okay, the minimum investment for this one is $100,000. It's 45 units. House was built in 1967. It was remodeled only 6 years ago, so it's not like we need a lot of capital expenditures on this particular deal. In the beginning anyways. Okay, it's currently 90% occupied, and we're looking to raise $2 million. All right, and so let me go ahead and go through some of these other slides here to give you more details. All right, so you'll see here that the price is $8.5 million. Now, what that number represents is the total all-in amount, including closing costs, the loan assumption fees, and so forth. Okay, so when we're assuming that $6.5 million loan, there is a fee that needs to be paid to the lender to assume that loan. That's included here in $8.5 million. Okay, so the cost per unit is roughly $188,000 per unit. Okay, and then the cap rate is here, the current. So we got the left column, which is current, and the pro forma is the target that we're doing in the next 3 to 5 years. So 6.8% cap rate going to 9.57 cap rate. All right, and then going down to the unit mix, you have 6 units that are 1 bedroom, 1 bath, 7 units that are 2 bedroom, 1 bath, 24 units that are 3 bedroom, 1 bath, and 8 units, 4 bedroom, 1 bath. Okay, so the current rents are here. You'll see them on the table here, but the market rents are much higher than where it is. Okay, now let me tell you a little bit about a background about this property. The current owners have not leveraged the current voucher rates with DC for Section 8. All right, now a lot of people worry about DC with regards to it to being a tenant-friendly environment versus a landlord-friendly environment, but if generally that is an issue if the tenant is not paying rent. Because if they don't pay rent, it's hard to get them out. But if there's Section 8 people in there, the government never misses a check. Okay, so the TOPA laws really doesn't really matter for us because they're getting paid by the government anyways. We're not depending on the actual tenants for paying these rents. Okay, so the vouchers in itself right now in the year 2024 has not been leveraged fully at what's qualified. So the more bedrooms you have in any one unit, the higher the Section 8 vouchers are that the government's willing to pay for that unit for that particular family. So generally, like if there's a family of 5, 3 kids and 2 adults, they require you to have at least so many bedrooms. Let's say 3 bedrooms or 4 bedrooms. Okay, so because of that, they're gonna pay a lot higher for that unit to be able to accommodate that family of 5 people. So you see a huge differential in what the rents are that Section 8 will improve and what's being charged right now because of the mismanagement of the current owner. Okay, so this is just the next few slides, is just a breakdown of each unit. Okay, so you'll see here, there's a handful of ones that have identified as vacant already, excuse me, as vacant, but actually there's only 4 vacant units out of 45 units. So it shows here there's probably 6 or 8, but 4 of them are already occupied. But you'll see here, the scheduled rents and potential rents, there's a big disparity between them, okay, when you look at the charts here. So, for example, down here, you got the 4-bedroom. It's $1,800 a month, okay? $1,800 a month, but then you have a $3,100 a month potential rent for the Section 8 qualification, okay? So it's a huge spread of increasing just from that one thing right there, okay? So going on, all right, this is just the operating statement. So the whole goal, again, is to increase the operating gross rents. So you see the current rents is roughly $1 million, all right? And the goal is to increase that, and as that gets increased, the value of the property will increase as well, and that's where we get the equity growth from, all right? We distinguish the value of multifamily by what we call net operating income, and this is the number that is coming to us after expenses are paid, but before debt service. So here you'll see that the current, all right, there's only about $250,000 difference between gross rents, but then you'll see almost a $300,000 difference between net operating income. And the reason why is not only because the rents are increasing, but we're becoming more efficient on the expenses as well. Okay. So here's our business plan for this particular deal. Acquire this property in September 2024. All right. We're going to stabilize the rent rates with DC affordable housing, leading to an increased net operating income and value. Okay, that's our first goal. The next thing is that we're going to start adding income producing strategies, including but not limited to new laundry facilities, which there's room for. All right, vending machines, valet trash pickup, and much more. So we have a lot of things that with regards to the laundry facilities, we're allowed to put into there's space for us to install that altogether, but it's not going to cost us capital expenditure to buy washers and dryers, but instead we're allowed to have a lease agreement with these washers and dryers for them to put these machines in there for them to make money, but we get a share of that profit. So in other words, we're not going to handle maintenance of the washer and dryer. We're not going to install the units. We're not going to do the plumbing. They hook it all up. The plumbing's going to be already there, but they're the ones that's doing all this, but then we just get a profit share off their revenue from the laundry facilities, okay? And then there are existing solar panels on the top of the roof that are not tapped into yet. So there's actually a lot more space to install the solar panels. And DC, it's been a really big deal, big money maker for solar panels, because the power company in DC is Pepco, and they're always having, you know, brownouts in certain areas, and so they're willing to pay for extra power that we don't use, all right, through our solar panels back into the grid, and that's additional cash flow and income as well. All right, and of course, through the rents that we collect on a monthly basis, we're going to pay down our loan, all right, and that's going to increase the equity of the assumed loan. Okay. So here's the capital investment details. Okay, Fortune Homes Capital is looking to raise $2 million in increments. I'm sorry, there's a typo here. It actually should be an increment of $100,000 each. Okay, so it should not be $50,000. It's increments of $100,000, $2 million total. Okay, and the duration will be up to 48 months. The deadline to commit is Wednesday, the end of the month. Okay, if you need a little bit more time, we can sort of talk about that and go from there. All right, so here are the major milestones. Okay, acquisition is September 2024. That's when we would need the funding by to close the deal. And then from there, start beginning our value add plan shortly after everything's settled with all the logistics and everything, to start a value add plan with the DC rents, with affordable housing, the solar panels, and other things in October 2024. And we're looking to either sell it or refinance it by fall of 2028 sometime. And that's when you can expect to get your principal back plus the equity growth, okay? So the offerings are, you know, because this is a multifamily deal and there's rents being paid every month, there will be quarterly payments of what we call preferred returns. And we're going to talk about this in the next two slides. And then this also would depend on the investment amount, okay? So let's go through that right now. So let's say you want to commit to $100,000. So you take a look at year one. When you invest $100,000, you're going to get, and then this is all annual numbers, okay? You'll get a preferred return of 7%. So 7% of $100,000 is $7,000. That's per year. So we're going to make those payments every 3 months, so every quarter. So you take the $7,000 divided by 4. All right. In this case, it's probably just under $2,000. That's going to go into your bank account on a quarterly basis. Okay. And then you see here, year 2, it's the same thing. Year 3, same thing. Year 4, same thing. Year 5 is where the magic happens. Okay. Year 5 is where we would have improved the net operating income to where it's now the pro forma and increased value to where we can refinance it, and we can sell the property at higher value. So when we do that, what ends up happening is that the increase in value of the house from the refinance or the sale will have a lump sum here. In this case here, 35,000 and some change into the actual deal. So you take a look at all the numbers together. Year 1 through 4, you're getting $7,000. But then year 5, you're getting $42,000 for a total of $70,000, or an annual return of 14.12%. Or in this case here, a 1.7x return on your investment for $100,000. Okay, so that's if you invest $100,000. Now, if you get closer to investing the full $2 million, right? Or now it may not be the full 2 million, but it could be $1 million, it could be something pretty high. Then we can go ahead and look at increasing this even further. So we're able to increase your returns because the cost of administering each account becomes less for us. Okay, so we pass those savings on to the investor. So in this case here, if you want to invest a full $2 million, you'll see here the difference is that the preferred return is, instead of 7%, it is now 8%. So on $2 million, every year, you'll be getting $160,000. So again, divide that by 4, and whatever that number is, that's $40,000 per quarter. That $40,000 will be going to you on a quarterly basis from our rent proceeds, okay? And then on year 5, you'll see here that the increase in equity is now $800,000 on the full $2 million. So you put that all together, the $800,000 return through 5 years from the preferred return, and then the equity growth from there, another $801,000. That's $1.6 million, or what I would call a 1.8x return on your investment. In this case, an annual return of 16.01% annualized. Okay, so unlike rehabbing, the great thing about this investment is that you're not looking for another deal every 9 to 12 months. Your money is solely focused on here for you to enjoy the cash flow and the equity growth down the road. And then the 4th year, when we sell or refinance the house, you get all your money back. Now at that time, you can start looking at another deal to reinvest in, but you're doing it not so often. All right. And while and remember, when you're looking for another deal to invest in, there's that time when the money is in your account that's not performing and not getting any returns whatsoever. Okay. So that's the benefit of doing a multifamily, because that money continues to perform throughout a long period of time. And you also get cash flow, even though the deal is not completely done yet. Okay, so here's our sponsorship team. All right, we got the owner of SE Real Estate LLC, Victor Chopra, one of my buddies that I'm doing this deal with. He's been doing this for many years, since 2017, and he's had a huge portfolio of success of multifamily buildings in DC. He lives out in the Maryland area. I personally live out in the Virginia area, and we're working on this deal together. So myself, I've been doing real estate since 2011. I have a master's in aerospace engineering from North Carolina State University. Used to be a government contractor at NASA, at Department of Defense and Department of Homeland Security, did all those great things, but then started doing real estate investing and found my passion in doing development and helping others succeed in getting their capital to grow in a very in a way that will beat inflation. Okay, so we're partners with SE Real Estate LLC in this particular deal, and I am responsible for capital syndication, construction needs, and also materials acquisition. So the great thing about this is that when they do construction for us, the reason why the returns that I share with you might be a little bit conservative, it might be even higher, is because when they use our construction company, I have agreed that we would do it at a very minimal profit or even at cost. Okay, so that way we can improve the returns on investment of the actual capital investors as well and put the deal in less risky position. Okay, all right. And then a couple of things about the DC marketplace. All right, so you'll see here that the location of the property is right here in this little southeast area of the diamond for Washington DC. But the employer map, we have a lot of employers in the area. Some big ones, of course, we've got the Congress, got the government. But Amazon, all right, they have a very big facility out in Arlington. The Marriott International headquarters is also in Bethesda. Lockheed Martin is also in Bethesda nearby, Georgetown University, Howard University, Fannie Mae, Capital One, all right, and so many other big companies, name companies that has a lot of employment base. You know, they employ thousands, if not tens of thousands of employees in the area. So the job market is very, very strong in the DC area. Okay. All right, and then also just nearby, this is probably walking distance, several blocks down the road, but there is a development down the road. It's called the Fletcher Johnson redevelopment that's happening down there. It's supposed to start not too long from now. So when it does start, it will only improve our returns because of the value and the proximity for our particular deal. Okay, so we did not really account for any kind of growth from this particular thing, but if this development that's near our house, near the multifamily building, has a positive effect, then we'll take that as a bonus. Okay, so we are very conservative when we're doing the assessments on the deal, and then all these things that we mentioned just so you guys know about it, and we get a bonus. That's great. If not, then then that's okay, because we weren't expecting it anyways. But again, if something does come to play, then that's great. Okay, and then the next step is pretty simple. All right, so if you're interested in doing any kind of capital investing, whether that deal I just shared or other particular deals, go to our website at fortunehomesteam.com and submit a form for us. So that way we know what kind of investor you are, what kind of risk tolerance you have with regards to the duration of the investment, and also the amount of capital that you have and what your goals are for the next several years. So that way we can take that into account for you to be able to do we take that into consideration for your investment. Okay, so complete the investor application. So once you finish the initial form, you'll then complete an application. So that way we have all the things we have to create your account. All right, then we'll complete a promissory note, and then we deploy the capital once it's ready. Okay, so if you're interested in any one of the current opportunities that we just shared, then just let us know, and we'll talk more about that in person. Okay, and then of course, who do you know? If you want to commit to the full $2 million, and maybe you don't have enough, and you know other people with, so you can pool it together into one account or to one LLC that you guys form. So that way you guys can have the higher return. And then when it goes into that LLC's account, then between you and those other people, you guys can divvy it up accordingly if you want to. Okay, so the worksheet is on this website. So if you go to fortunehomesteam.com, all right, just click on our services on the website, and then on the fourth link, it says put your money to work. So you click on that right there, and there's a form there for you to fill out. And on that form, it has your name, your information, and some of the questions that you'll need for us to determine what kind of a capital investor you want to be, and go from there. Okay, and now it's time for any questions we have on this particular deal. So I know I've spoken a lot for the last 40 minutes or so, but are there any questions at all with regards to this particular deal or capital investing in general? Any questions at all? No questions? If you're talking, I can't hear you. It might be muted out. You unmute your mic there. Bogey, I see your
Okay,
thing is unmuted, but I can't hear you for some reason. Oh,
I'm here.
there
Okay.
you go. Okay. There you go. But Bogey, do you have any questions?
Not yet. Could you send that presentation for me?
Yes, I can do that.
Yes, okay.
Okay. And also, once this recording is available on Zoom, I'll send the recording for you as well. And that way you can
Yes,
have it as reference, okay?
okay, thank you.
You're welcome.
Mm.
Okay. Anybody else? Nobody else? Okay. Well, thank you so much, guys, for joining this webinar. I'll have the recording ready and sent out to those who registered for this event, for those who couldn't attend. And any questions at all, just feel free to reach out to me and we'll go from there, okay?
Mhm.
All right.
Okay. Today,
Okay.
right now, I'm not ready to ask a question, and also next time. Thank
Okay.
you.
No problem. Okay. Thank you so much, okay? Take care now.
See you next time. Okay.
Okay. See
Bye.
ya.